Do dividend stocks really pay off? Today we'll find out by building the Dividend Growth Model in Excel. It's a simple formula that tells us what a stock should be worth based only on its dividend. We'll take three inputs: the current dividend, the expected growth rate of dividends, and the required rate of return. Then Excel will calculate the fair value of the stock. By the end, you'll know exactly how to apply this to any dividend-paying company. Let's set up our assumptions. Current dividend $2 per share, expected annual dividend growth 5%, required return, our discount rate, 8%. The dividend growth model is given by where D subscript 1 is next year's dividend, R is the required return, and G is the growth rate. In Excel, we take the current dividend and multiply by 1 plus G. That gives us next year's dividend, $2.10. Now divide next year's dividend by required return minus growth. So 2.10 divided by 0.08 minus 0.05. That gives us a fair value of $70. So according to our assumptions, the stock is worth $70 per share. If the market price is lower, it might be undervalued. If it's higher, maybe overvalued. But remember, everything depends on our inputs. If growth is only 3%, the fair value drops to $52. If investors require 10% return, it falls even further. The dividend growth model is simple but powerful. It shows how sensitive stock value is to growth and required return. You can download this Excel file in the description and try your own assumptions. If you enjoyed this, check out my next video where we build a portfolio risk calculator in Excel.
Okay, so our fair value is $70 under these assumptions. But here's the thing, the dividend growth model is extremely sensitive to the inputs. Even small changes in growth or required return can swing the valuation a lot. That's why I've added a sensitivity table. Here's how to read it. Across the top, we have different growth rates, from 3% to 7%. Down the side, we have required returns, from 7% to 11%. Each number inside is the fair value of the stock, given that combination. Let's look at the 8% required return row. If dividends grow only 3%, the fair value is about $41.2. But if they grow 6%, the fair value jumps to $106. That's more than double, just from a few percentage points difference in growth. This is why dividend valuation is as much art as it is science. The model is powerful, but it's also fragile. If your assumptions are off, the value can change dramatically. So whenever you use this model, it's not about finding one true value, but about understanding the range of possible values depending on your outlook.